Hi, everyone. Welcome to Introduction to Angel Investing. We will be talking about the basics of angel investing in this webinar. My name is Rashad. I'm a family physician and an active angel investor. I closed my startup earlier this year, and since then, I've invested in three startups in the health tech space. And the goal is to invest in about 20 to 25 over the next 3 to 4 years. I'll start with a basic definition of angel investing. Angel investing is a high risk, high reward investment strategy where you're deploying capital very early on in a startup's journey. Usually, you're one of the first checks in a startup outside of friends and family. It's almost always before what we call product market fit, which is essentially when the startup has found a growing market that really wants their service or the product they're selling. As the company matures or gets bigger, venture capitalists come in who write bigger checks. From a strictly risk reward perspective, I would say Series A is likely the best place to invest, but the check sizes here are usually a little bit too large for angels to come invest in. And generally, it's more venture capitalists who are investing larger check sizes. To give you an example, I invest about ten to $25,000 per check, whereas in a Series A, the minimum check size would be usually about 50 to 100,000. The reward I'm looking for as an angel is a 100x return on my capital, as opposed to a venture capitalist who's looking at about a 10x return. My chances of success on average are about 10%. And the further along a company goes in its growth, the higher the chances of success. The way you get your money back is when there is an exit, um, which could be an acquisition, an IPO, or the company fails. And in that case, you don't get any money back. An acquisition is when a bigger company buys your startup or the startup you've invested in. An IPO is also called an initial public offering. Essentially, that's how a company lists on the stock exchange. How risky is angel investing? So, the best angels have about a 20% success rate, which means one in five of their investments succeed. Now, success here is hard to define, but essentially any exit that returns money is defined as a success. Most of your investments will only return initial capital, which I would say about 10 to 20% of your successes returning a 10 to 100x return. And those more than make up for all your other investments. 10% is more realistic for someone like myself starting on. And the more I learn, the better I get at this, the higher my chances of success. Angel investing, I would not say it's a passive investment strategy. If you're deploying, millions of dollars and investing in hundreds of companies, sure, you can treat it as a passive investment strategy. But for someone like myself who's thinking about 20 to 25 companies, um, it is a numbers game, but I have to be more active in my investments. And I'll talk a bit more about how you can be active in angel investing. The one thing to keep in mind is your failures appear before successes, and that's just the nature of the game to an extent where startups and companies in general tend to fail fast, but success takes a little bit longer. For biotech pharma companies, this could take up to 10 years as they have to go through quite a bit of research and development, and FDA approval can take some time as well. The minute the average time for an exit or the average time before you will get your capital back is about 5.5 years. Um, as I said before, it is a numbers game, so you do want to invest in at least 25 startups. So why should you invest in startups? Everything I've said so far, it's high risk. You have to invest in 20 to 25 startups. You have to deploy a lot of capital. It's an active investment. Um, you only need one success that more than makes up for all of your failures in angel investment, and you should go in with the mindset that you're kind of chasing um, a 10 to 100x return, and most of your companies will not return money. I think you need to have an inherent motivation and an intrinsic just. I like talking to founders and I have fun with that. So I think if you are the type of person who likes talking to founders, helping solve difficult problems, if thinking about being at the very beginning and investing in Facebook or Twitter or these companies that have really are behemoths now is exciting to you, then it might be a good option. I would not angel invest with more than 10% of your investment assets. So my personal investment assets, again, this is not financial advice, um, is in index funds. And I'm only investing in about 10% of my investment strategy. So you need to be comfortable with risk. This is a very high risk investment strategy. And also your money is illiquid, which means it's tied up for 5 to 10 years. There's usually no way of getting your money back until there's an exit, which, as we talked about before, is the startup gets listed on the public market or a bigger company buys it. There are some very rare exceptions to that, but in general, when you're investing in startups, I would know that your money is tied up for a minimum of 5 years and up to 10 years. So, how can you maximize your chances of success? There's been a couple papers on this, and these are the things they identified of how you can maximize your chances of success. Due diligence is a process by which you select what to invest in. So, there's a the next webinar will go into a lot more detail about what due diligence is and how to conduct it. But essentially, the more hours you spend researching a company, the higher returns. And the key number here is about 20 hours lead to about a 5.66 higher return. Having deep industry expertise also increases the return. I know most of my audience are physicians, so we're really in a good space here as we have deep expertise of the pain points that physicians face, that patients face, and also how to sell in this industry, especially if you're making a product that you're selling to physicians. The more you interact and the more you help your startups after you invest, the better the chance of success. Some ways you can help with is leads with who they're selling to, feedback on their product, and helping them with fundraising as well. So, how do you find deals? It's still somewhat of a secret society, and the best deals you get in through your network. There's lots of events going around. If you just Google investing events or startup events in your local area, lots will come up. Two big ones in Canada are Collision and Elevate. For healthcare, I'll give you guys some in my newsletter as well. But HIMSS is a big one, and Vive and HLHT is coming up in Vegas in the next couple of weeks. Uh, you can also look at crowdfunding sites. I am not a biggest fan. I like talking to founders in detail before I invest. Generally, you will not get the best quality deals in crowdfunding sites, but the advantage of crowdfunding sites is you can invest as little as $100 in some of them. AngelList also has a lot of deals. You can invest in syndicates and rolling funds. And we'll talk about what syndicates and rolling funds are at a later date, but essentially, you give people money to invest on your behalf, and they take a management fee and a percent of your profits. It can be a good strategy. It's similar to venture capital. Usually, you have to invest at least 25, and sometimes the minimum is 100,000. Um, it has a higher success rate, anywhere from 20 to 50%, depending on which firm you're looking at. And usually you'll get about 20% per year. But again, the money is generally illiquid and you can get it back for at least a few years. Some venture capital firms will give you your money back annually if you'd like. Um, so, how do you do due diligence? So as we mentioned before, more than 20 hours correlates with 5.6x higher returns as opposed to less than 20 hours. Daniel Kahneman is a famous psychologist and economist. He wrote the book Thinking Fast and Slow, and he talks a lot about decision making and essentially when to rely on intuition and when you need a structured approach to decision making. He divides the environments in which you require intuition versus a structured approach into high and low validity environments. High validity environments are slow or static. They're not changing much. They're highly repetitive. You're doing the same thing over and over and over again, and they provide immediate and accurate feedback. So Clinical practice is a very good example of a high validity environment, especially where I work in urgent care. I'm seeing patients daily. It's the same setting every day. And I usually know in a day or two if they got better or not. Most of them will come back if they don't get better. Um, it's a environment in which, according to Daniel Kahneman, and I think he's right here, you can rely on intuition. As we said before, angel investing, you're investing in maybe 10 times a year. You're not getting any feedback for at least a few years to know if you were successful or not. So it's a very low validity environment. And then every startup is different. It is not static at all. Um, so what that means is that it requires a structured process. You will see a lot of people, I think, in this industry, more so than should be relying on intuition and succeeding. But I would know there's a big reporting bias there with people who rely on intuition and didn't succeed usually don't report that. Um, I would have a structured approach. That doesn't mean you should not rely on intuition at all, but I would add your intuition after your structured approach. Hiring is a similar thing, as a low validity environment. So when you hire someone, or when you're looking for a co-founder, or even a partner, to be frank with you, you should have somewhat of a structured approach, to an extent. So I'll kind of briefly go through this, but we'll talk. The next webinar will be an hour-long webinar just on due diligence. And to be frank with you, we can talk about hours and hours on this. Um, these are some of the things I look for in due diligence. But again, I think there's a lot going on here, so I just wanted to show this slide. Um, yeah, the most important thing, interestingly, is market timing, which is a not true for the public markets. So what I find a lot of people try to do is make comparisons between real estate or investing in stocks and investing in startups, and there's not many parallels you can make. To be frank with you, just because it's such a different industry and such a different ball game, and it's such a different stage of the company when you're investing in a startup very early on. Sometimes they will change their product completely. Um, Twitter, I believe, was a video podcast platform initially before they pivoted to Twitter. Um, so, I would, talking a bit more about market timing. There was a study by Bill Gross of Idea Lab, and he looked at thousands of startups, and he found that why now, or is this the right time? Is the market ready? Was the biggest predictor of success, ahead of who the team is, ahead of what their business model is, which kind of makes sense. There's a famous example of a company called Webvan, which was Instacart before Instacart. There's another company, General Machine, I believe, and I'm sure people will correct me if I got that wrong, that made the iPhone in the 1980s. But both of those companies did not succeed. So, how do you actually invest? As opposed to buying stocks in which you can go through your bank or something like Robinhood, you can't really buy shares in a public market as these companies are private. So usually they'll raise different rounds, and as I mentioned earlier, there's a pre-seed, seed, Series A, B, C, and as they raise these rounds, you can get a chance to invest in these companies. As safe as a simple agreement for future equity. Usually, what you're saying here is, I will give you money now, and then I will get equity at the next financing round. A convertible note is a debt instrument in which there's an interest. So, for example, if you invest 50,000, there's a 10% interest on it, in a year on that 50,000 is 55,000, and you can convert that into equity in the company when they raise their next round. Um, there's a price round in which you just give the money and you get shares right there and then. It's rarer, but it does happen. A few things to know about this, and I'll mention them briefly, but we will go over this in one of our webinars in the future. Is a discount cap and a valuation cap. A discount cap is in a safe say, you say, I'll give you 50,000 at a 10 million valuation. So if the round in their next round is at 20 million, you can still invest at the 10 million valuation, when your safe converts to equity. And that's a discount cap is you just get a discount on what you're investing. So usually it's about 10 to 20%. I almost always ask for a valuation cap, and I don't invest in a strictly discount cap. Um, so when do you get your money back? This is why your investment is illiquid and it can be locked up for quite some time. You need an acquisition event or an initial public offering. In a dissolution or where the startup fails, you generally don't get any money back. You can have what we call a liquidation preference, where you would get your initial capital back, but that's after all legals, accounting is done, and usually there's not much left. Um, an acquisition event, as we said before, is when a bigger company buys your company. So, how Facebook bought Oculus as an example. Um, you can sell shares in the private market, but I would not count on that. That's more kind of off the cuff and happens rarely. So, what do you do after you invest in a startup? So, as we talked about before, it is a active investment strategy. Ask the founders what you can do to help support your investment. Invest in more. It is a numbers game. Follow on your previous investments, see what went right, see what went wrong, and identify your key points of failures and success. And then keep learning, keep up to date with market events. As market timing is one of the best predictors of success. As the markets change, new startups might be they might work now where they didn't before.